Indebted consumers will be squeezed even harder as the Reserve Bank continues its rate hiking trend, which has pushed debt repayments higher. Consumers have been battling the rising cost of living characterized by high inflation and rising interest rates that have wiped off households' disposable income. Inflation is currently at 7%, notably above the central bank's target range of 3 to 6%. Economists say it's highly likely that the Reserve Bank will raise rates for the 9th time since the current hiking cycle began in November of 2021.
My expectation is that we will see an increase in interest rates. It might be as big as 50 basis points. The reason is that inflation is not under control in South Africa, as we've seen from the most recent inflation figures. And at the same time, inflation expectations are still running high. And monetary policy has to focus also on inflation expectations. You have to rein in inflation expectations in order to bring future inflation down to within the target range. And of course, the Reserve Bank's specific focus, namely on the midpoint of the target range.
While the high interest rate environment may be hard for indebted consumers, it's good news for those with savings.
Inflation is always bad to consumers. And of course, in an environment of rising interest rates, the advice to consumers is to borrow less, make sure that they keep their debt under control, make sure that they can meet their commitments. And at the same time, of course, we have to remember that higher interest rates are good for people who save, people who have money in the bank, and people who earn money on their savings. So there are those who are really worse off as a result of higher interest rates, but there are also those who will reap benefits from higher interest rates in the South African economy.
Inflation is seen averaging 5.4% this year and slowing further to 4.8% next year. Gloria Sefako Mosi, SABC News, Johannesburg.